Certainly, 2010 looks to be a better year than what we've had in the past. That's not saying a whole lot, but somewhat tighter hog supplies in the U.S., fewer hogs coming from Canada, add up to what I'm showing is a reduction of annual slaughter of about 1.4% this year. The resumption of exports to Russia and China and post H1N1 situation will help demand some. So we're looking for prices in the mid-60s for the year on a carcass weight basis. That would be national net price, with some prices up into the low 70s, maybe as high as $74, $75 a summer. As of yesterday, the futures markets on corn, soybean meal, and hogs were offering profits of about $3 per head based on my model for this year if you wanted to lock those in. That's down from about $10 a week ago, but still profits for this year would be far better. The last 2 years we've averaged over $20 per head loss.
Did we see the kind of reduction that we wanted in the sow herd, or what are some of the other things that happened with the reductions or lack thereof?
Well, in my opinion, I think we still need to bring the sow herd down some. I think we need to come down to somewhere around 6.8 million for the U.S.-Canadian herd, and the Canadian herd's probably headed to 1.2 million or so, and that means the U.S. herd needs to go to 5.6, maybe as low as 5.5, and we're at 5.8 and change in December. So I still think we need to get smaller to kind of return us to kind of constant, or not constant, but regular profits. Right now, the futures market's offering a profit, but I think the futures market's a little high relative to where I and most other analysts have cash hogs for this summer. So I think we need to have some more reduction. Now, it's been a very slow process, though, for a lot of reasons. I mean, hog farmers want to stay in business. They had very good cash reserves going into these losses in the fall of 2007, so that gave them some staying power. There were a lot of them sold hogs on the futures market or with packer contracts based on the futures market and got much higher prices than spot market prices were. And if you go back and really look at the data, most months in the last 2 years have been very close to or actually covered variable costs. And economic theory tells us as long as you're covering variable costs, you stay in business. And so it's not a surprise that we've been kind of slow on this reduction. I still think we need to reduce some more if we're going to get prices high enough to cover these new cost levels, which are somewhere 25 to 35% higher than what we've had in the past.
Just in summary, what are you hearing from producers, and what can you offer as encouragement for those who are in the business to stay?
Well, I can offer as encouragement that this year is going to be better. You ought to be able to hold your money together this year. I think most people are in a position where they don't have much cash reserves, so they probably need to be aggressive risk managers, at least for this year and next. I'm hearing from producers that most of them kind of have that viewpoint. It's been a long, tough 2 years, but the ones that are still here are committed to the business, and I understand that, and they know how to raise hogs, and they know we're still going to have a product that's in demand, but the increase in input costs has to be covered either through higher demand or lower supply. There's only two ways to do it. And while demand may pick up some, it's not probably going to pick up enough to do this. So we're headed for lower supplies of all the meats and poultry proteins and higher consumer costs. And that's going to be something we have to deal with probably this year and next, is that we're going to have record high retail prices, and that's going to have some ill will involved in it too. So while things are better, there's still challenges ahead.